You've found a company you love. You've done the research. You're convinced it's a great business. But now you're frozen. Is now the right time to buy? What if it drops tomorrow? And for those of you who already own stocks, the question is even more paralyzing. When do you sell? Do you sell when you're up 20%? 50%? What if it keeps going up after you sell? Or what if it's down? Do you sell to avoid further losses, or is this just a temporary dip and you should buy more? This buy and sell dilemma is where most investors make their most costly mistakes, driven entirely by fear and greed. But what if you had a system? A set of unemotional, predefined rules that told you exactly when to pull the trigger. Today, that's exactly what I'm giving you. This isn't a crystal ball, it's a checklist. A practical framework for making rational buy and sell decisions, so you can stop guessing and start executing with confidence. Let's start with the buy decision, because everything begins there. The single best time to buy a stock is when it's trading for less than your estimate of its intrinsic value. I know that sounds abstract, but let me make it practical. You've researched the company and you believe, based on its earnings, growth prospects, and competitive position, that it's truly worth $50 per share. The market, however, is currently pricing it at $40 per share. That disconnect, that $10 discount, is your opportunity. You're buying a dollar for 80 cents. This is the core of value investing. But how do you find these opportunities? They often appear when a great company faces a temporary problem. A negative news headline, missed earnings estimate by a penny, a lawsuit that doesn't threaten the core business. These events can cause a panic-driven sell-off that creates a fantastic buying opportunity for the calm, prepared investor. Another great time to buy is when the entire market is in a bear market. When fear is rampant and everyone is selling, high-quality companies are put on sale. As Warren Buffett famously said, be fearful when others are greedy, and greedy when others are fearful. For growth investors, a good buy point might be after a stock has broken out of a consolidation period on strong volume, but the fundamental principle is the same. You're buying because the future potential outweighs the current price, not because the stock is going up and you're afraid of missing out. Now, let's talk about the sell decision. This is where discipline makes or breaks an investor. There are 3, and only 3, good reasons to ever sell a stock. The first and most important reason is that your original investment thesis was wrong. You bought the stock for a specific reason. Maybe you believed their new product would be a huge hit, but it turned out to be a flop. Maybe you thought they had a durable competitive advantage, but a new competitor has emerged that is truly threatening their business. When the fundamental reason you own the stock no longer holds true, it is time to sell. Don't fall for the sunk cost fallacy, holding on hoping it will come back just because you're down. Admit the mistake, learn from it, and move your capital into a better opportunity. The second good reason to sell is when the stock becomes drastically overvalued. Let's go back to our example. You bought a stock you believed was worth $50 when it was $40. Now, due to market euphoria, it's shot up to $90 a share. The business is still good, but the price is now insane, far exceeding any reasonable future growth projection. This is when you take profits. Selling an overvalued stock is not a betrayal of the company, it's a rational capital allocation decision. The third good reason to sell is if you find a significantly better opportunity. Your capital is a finite resource. If you own a stock that you think will return 8% per year, but you identify another one with similar risk that you believe will return 15%, it is rational to sell the first to buy the second. This is the concept of opportunity cost. Now, let's talk about the wrong reasons to sell, because this is where most money is lost. Never sell a stock simply because the price has gone down. If your research is sound and the company's fundamentals are still strong, a price drop is often a chance to buy more, not a signal to panic. A temporary dip driven by market sentiment is noise, not a signal. Conversely, never sell a stock simply because it has gone up a lot. This is called picking weeds and watering flowers. You're selling your winners too early and letting your losers run. If the business is still executing and the valuation is reasonable, let your winners run. They are your champions. Another terrible reason to sell is because of a gut feeling or a tip from a friend. Your investment decisions must be grounded in research and your predefined strategy, not in emotion or hearsay. Implementing a simple tool like a stop-loss order can add discipline, but be wary it can also lock in losses from short-term volatility. The goal is to be a business owner, not a stock price watcher. So, how do you operationalize this? You need a written investment thesis for every stock you own. This is your personal contract with yourself. When you buy a stock, write down your answers to these questions. Why am I buying this company? What are the key metrics I will follow to ensure it's on track? At what price would I consider it overvalued and a sell? What fundamental change would make me reconsider my investment? Keep this thesis in a journal or a simple spreadsheet. Then, when the stock price gets volatile, you don't need to panic. You simply pull out your thesis and ask, has anything changed? If the thesis is intact, you hold or even buy more. If the thesis is broken, you sell. It's that simple. This process removes the emotion and turns you from a reactive trader into a proactive business owner. A pro tip is to schedule a quarterly portfolio review for yourself. Go through each holding and reassess its thesis against the latest earnings reports and news. This structured checkup prevents you from getting lazy and falling in love with your stocks. Before we conclude, a critical disclaimer. Timing the market perfectly is impossible. This framework is designed to improve your odds, not guarantee success. All investing involves risk, including the total loss of principal. The stock market is volatile, and even the most well-researched investment can go down. This content is for educational purposes only and is not financial advice. You are solely responsible for your own investment decisions and should consult with a qualified financial advisor who understands your personal situation. The strategies discussed, like holding through volatility, require a strong stomach and a long-term perspective. To bring it all together, knowing when to buy and sell comes down to a disciplined, predefined process. You buy when a quality business is available at an attractive price. Often when it's facing temporary troubles or the whole market is fearful. You sell for only 3 reasons. Your initial thesis is proven wrong, the stock becomes dangerously overvalued, or you find an unequivocally better place for your money. You avoid selling out of panic when the price drops or out of impatience when the price rises slowly. By writing down your thesis for every investment and reviewing it regularly, you build a system that protects you from your own worst enemy, your emotions. This is how you transition from being a speculator, tossed by the waves of market sentiment, to being an investor, guided by the compass of rationality and discipline. Now I'm curious. What's the hardest part of the buy or sell decision for you? Let me know in the comments. Thanks for watching, and I'll see you in the next one.